Hello everyone, let's look at an exam style question for the financial accounting paper. Now, this question was asked in the previous examinations, if I recall, somewhere in 2023. So let's dive in. At 1st April 2008, Companies Co. had a $300,000 6% loan note in issue. On 1st of June 2008, Companies Co. issued a $500,000 9% loan note. On 1st of January 2009, Companies Co. repaid the $300,000 6% loan note in full. And the question is, what figure should appear in the statement of profit or loss for finance costs for the year ended 31st of March 2000 X9. Now, when it comes to the financial accounting paper, the first thing you need to do is to always establish the accounting period. So here the accounting period runs from 1st of April 2008 to 31st of March 2009. Now, there are quite a lot of information here, but let's focus on each loan note individually. So let's focus on the $300,000 6% loan note. One thing you have to bear in mind is that whenever you're quoted 6%, it's always per annum. So with the first loan note, what's the deal? So the deal is this. So let's call this loan note 1. We will have to charge interest for how many months? Now, at the start of the year, the loan note was in existence. And we're not focusing on this one. We'll call it loan note 2 in a minute. So let's have it somewhere here. So we're focusing on loan note 1. We repaid the loan on 1st of January 2000 X9. So what does that mean? We will have to charge interest. So for the month of April, all the way to, let's say somewhere here, all the way until December 2008, isn't it? Because on 1st of January, we are repaying the loan note. So what's the deal? How do we calculate the interest? Well, it is 6% or 0.06 multiplied by 300,000. 300,000. Sorry about my writing, but I hope you get the point. 300,000. And then we have to multiply by how many months. So if we count the months of April, so April, May, June, July, August, September, October, November, December, that's 9 months. So multiply by 9 over 12. We'll come to the interest figure in a minute, but let's look at the second one. So the second loan note, which was issued on 1st of June 2000 X8. So let's say 1st of June was somewhere here. Okay, so that's 1st of June 2000 X8. And we haven't repaid this one, so it was still in existence at the end of the financial year. So all we have to do is count the number of months of interest. So for June, July, August, all the way until 31st of March 2000 X9. Now, if you count it, you will see it comes to 10 months. So what is the percentage for loan note number 2? So that's 0.02. 9, but remember this is always per annum, so multiply by 500,000, 500,000. But we have to also multiply by 10 over 12, the number of months. Now, what's the deal? Let's do the calculations, and basically we will need to add the two figures to find the total interest because we have two loan notes. So the first one, 0.06 multiply by 300,000 and then multiply by 9 over 12. So that comes to 13,000. So let's put the dollar sign, 13,500. But that's not enough. We also have loan note number 2, and this one is 0.09 multiplied by 500,000 and then multiply by 10 over 12, and that comes to 37,500. So what is the total interest charge? Total, if we take 13,500 and we add 37,500, well, total comes to 51,000. Sorry about the horrible handwriting, but there you go. So clearly the answer is A.